Ladies and gentlemen, today I'm here to talk to you about the 60/40 strategy, a simple yet powerful approach that has been the cornerstone of successful investors, entrepreneurs, and high achievers in various industries. But don't let its simplicity fool you. It's not just about allocating resources. It's a mindset, a principle, and a framework that, when understood and applied properly, can propel you toward financial success and personal growth. The 60/40 strategy isn't a trick, a get-rich-quick scheme, or some kind of gimmick. It's about smart, disciplined, and well-calculated decision-making. So let's get right into it. Buckle up, because what I'm about to share with you today could change the way you think about investing, entrepreneurship, and achieving the highest levels of success. Understanding the 60/40 strategy, the basics. Before we dive into the different ways you can apply the 60/40 strategy, let's first make sure we understand what it actually is. At its core, the 60/40 strategy is an investment allocation principle. It involves splitting your investments in a ratio where 60% of your assets are allocated to more stable, lower risk investments, and the remaining 40% goes into higher risk, potentially higher reward investments. It's about creating a balance, and what this balance does is protect your wealth while also giving you the opportunity to capitalize on growth. Now, let me be very clear. This strategy doesn't mean putting everything you have into just two types of investments. It means creating a portfolio that balances safety and risk in a way that positions you to win. But why 60/40? Well, it's simple. The 60% represents your stable foundation. This is your cushion. This is your shield against economic storms, market fluctuations, and any other external forces that might threaten your wealth. On the other hand, the 40% represents your growth engine. It's what drives you to push beyond the average, to take calculated risks, and to pursue opportunities that others might shy away from. Now, let's not kid ourselves. The 60/40 strategy isn't for the faint of heart. If you're looking for easy wins with minimal effort, you're in the wrong place. This strategy requires dedication, discipline, and most importantly, the willingness to make difficult decisions when others are too scared to act. The beauty of this strategy is in its adaptability. The 60/40 rule is not set in stone. It's a guideline, a principle. You can modify it based on your personal risk tolerance, goals, and the current market environment. There's no one-size-fits-all approach. You can adjust the ratio depending on your circumstances. But one thing will always remain constant. You must maintain that balance between safety and risk. If you go too aggressive with your 40%, you could lose everything. If you play it too safe with your 60%, you'll miss out on growth opportunities that could have accelerated your wealth. The key here is to find that sweet spot where stability meets opportunity. For those who think they can wing it without fully understanding the implications of this strategy, let me tell you this isn't for amateurs. You need to understand the markets, the economy, the risks, and most importantly, your own financial goals. If you don't, you'll fall victim to the whims of external forces, and you'll never make it to the top. The 60/40 strategy is about putting in the work, understanding the nuances, and executing with precision. And if you're ready to do that, then you got a shot at winning. The role of asset allocation in the 60/40 strategy. Asset allocation is everything when it comes to the 60/40 strategy. You can't just blindly throw 60% into one asset and 40% into another and expect results. It's about smartly distributing your investments across different asset classes to minimize risk and maximize potential returns. The first thing you need to realize is that the market is dynamic. It's not static. Things change. And this means your asset allocation strategy should never be a one-time decision. It's a living, breathing part of your overall financial plan, and it needs to be revisited periodically. When applying the 60/40 strategy, the key is to focus on diversification. The 60% of your portfolio that's focused on safer investments should still have its own diversity. It's not just about holding cash or bonds. It could include real estate, dividend-paying stocks, or even commodities that hold their value over time. On the flip side, the 40% that's focused on riskier assets, like growth stocks, startups, or speculative investments, also needs to be diversified. The riskier part of your portfolio might carry more weight, but you must still approach it with caution. A balanced mix of asset classes in both the stable and riskier portions of your portfolio helps to smooth out volatility and ensures that your overall wealth doesn't get wiped out during a market downturn. The second aspect of asset allocation is understanding the correlation between different asset classes. Stocks and bonds often have an inverse relationship. When stocks go up, bonds might not perform as well, and vice versa. Knowing these relationships is crucial when you're building your 60/40 portfolio because it allows you to hedge your risks more effectively. The more you understand about the interaction between different types of investments, the better you can position yourself for both safety and growth. Your 60% should not all be in the same type of asset. Similarly, the 40% should be diversified within riskier assets to ensure that if one investment fails, the others still have the potential to provide a return. But remember, just because something is labeled as low risk doesn't mean it's guaranteed. Safe investments can still fluctuate, and riskier assets can still deliver returns. This is where your experience and knowledge of the market come into play. Understanding how each asset behaves, not just in good times, but in bad times as well, is what separates successful investors from the average ones. The true power of the 60/40 strategy comes from your ability to read the market, understand the behavior of your assets, and adjust your allocations accordingly. Identifying stable assets for the 60%. Now let's talk about the 60% of your portfolio. This part is supposed to be stable, your foundation. But just because something is labeled as safe doesn't mean it's immune to risk. That's where many people go wrong. They think that low-risk investments are foolproof, but the truth is they're still vulnerable to inflation, market cycles, and even geopolitical events. So your job is to find the assets that give you the highest degree of stability while still maintaining some level of growth. The first asset you should consider for the stable portion of your portfolio is bonds. Government bonds, especially U.S. Treasury bonds, are considered one of the safest investments available. They're backed by the full faith and credit of the government, which means the risk of default is extremely low. But that doesn't mean they don't come with their own risks, like inflation risk. Inflation can erode the value of your returns over time, which is why you need to balance your bond holdings with other assets that can keep up with inflation, like real estate. Speaking of real estate, this is another great option for your 60% real estate. Real estate, when done right, can provide a stable income stream, and property values tend to appreciate over time. It's not just about owning properties in prime locations, it's about understanding the local market, the rental yield, and the long-term value of the property. Real estate can act as a hedge against inflation as rents and property values tend to rise with inflation. But remember, like any other investment, it requires research, effort, and a long-term vision. Dividend-paying stocks are another solid option for the 60%. While they're technically equities, they provide a level of stability because they pay regular dividends, which act as a steady income stream. These stocks tend to be from well-established companies with a history of profitability and reliable dividend payments. When selecting dividend stocks for your 60%, you should prioritize companies with a track record of consistent dividend payments and strong cash flows. And maximizing returns with the 40%. The 40% of your portfolio is where the magic happens. This is where you take your calculated risks. The goal of this part of your portfolio is not to play it safe. It's to go after assets that have the potential for significant growth. The beauty of the 40% is that it's meant to be volatile. It's meant to be risky. But with risk comes the potential for high rewards. If you get this part right, it can more than make up for the slower, steadier returns from your 60%. Growth stocks are the first asset class that comes to mind when we talk about the 40%. These are stocks and companies that are expected to grow at an above-average rate compared to other companies in the market. The risk here is that if the company doesn't live up to expectations, the stock could take a huge hit. But if the company succeeds, the rewards can be massive. As an investor, you need to be diligent in selecting the right growth stocks. Look for companies with strong leadership, a compelling business model, and a competitive edge in their industry. Startups and early-stage companies are another great option for the 40%. These investments come with the highest level of risk, but the potential for upside is enormous. Think about early-stage tech companies or innovative startups in emerging markets. Sure, most of these companies won't make it, but a few of them will hit the jackpot, and when they do, the returns can be astronomical. Investing in startups requires you to take a long-term view and understand the space you're investing in. You can't just throw your money at any startup. You need to do your due diligence, understand the market, and take calculated risks. Cryptocurrency is another avenue that fits the bill for the 40%. The volatility in the crypto market is extreme, but the potential for return is equally staggering. For those with a stomach to withstand the ups and downs, crypto can provide incredible opportunities. But remember, this is not a place for lazy investors. You need to be up to date with market trends, regulatory changes, and technological advancements in the crypto space. It's a high-risk, high-reward game, and only those who are truly committed will thrive. Regularly rebalancing your portfolio. The 60/40 strategy isn't something you can set and forget. You need to actively manage your portfolio. The market changes, your investments grow or shrink, and external factors like inflation or interest rates can affect your holdings. That's why regular rebalancing is essential. Rebalancing means adjusting the weight of your assets to maintain the desired 60/40 ratio. Let me tell you this, if you're not rebalancing your portfolio, you're leaving money on the table. Here's how it works. Over time, the values of your assets will change. If your 60% portion of your portfolio grows at a faster rate than the 40% riskier portion, your portfolio may end up with more than 60% in safer investments and less than 40% in riskier ones. That's not what you want. You want to maintain the proper balance to ensure your portfolio keeps performing at its maximum potential. Rebalancing isn't just about selling off assets to hit a target, it's about making smart decisions. If you're overweight in one asset class, you might sell some of it to bring the balance back, but you might also choose to buy more of an underperforming asset class to restore balance. The key is to avoid knee-jerk reactions. Don't panic when markets drop or rise. Instead, take a disciplined approach, stick to your strategy, and adjust accordingly. When rebalancing, you also need to consider the tax implications. Selling off assets might result in capital gains taxes, So it's important to do this in a tax-efficient way. Some investors even choose to rebalance their portfolios using tax-deferred accounts, like IRAs, to avoid triggering taxes until a later date. The more efficiently you can rebalance, the more your portfolio will work for you. The psychological edge of the 60/40 strategy. Let me tell you something. The 60/40 strategy isn't just about numbers. It's about your mindset. You can have all the knowledge, all the tactics, and all the resources in the world, but if you don't have the right psychology, you'll fail. The key to applying the 60/40 strategy effectively is having the mental discipline to stick to your plan even when things get tough. When you're in the riskier part of your portfolio, the 40%, there will be times when you'll be tempted to panic. The market will be volatile, your assets will fluctuate, and you'll feel the pressure to act. But the most successful investors aren't the ones who react to every little market movement. They're the ones who have the patience to let their investments play out over time. The 60% of your portfolio gives you the mental peace to withstand those fluctuations. When your riskier investments are down, you can take solace in the fact that you have stability in the form of bonds, real estate, or other low-risk assets. And when the market is booming and your 40% is soaring, you'll feel the exhilaration that comes with taking calculated risk. But remember, don't let the high times cloud your judgment. Stick to your plan, stay disciplined. The psychological edge of the 60/40 strategy is the ability to control your emotions. Whether it's fear during a downturn or greed during a boom. The impact of market cycles on the 60/40 strategy. In the world of investing, market cycles are inevitable. They come and go, ebb and flow like the tides of the ocean. If you want to succeed with the 60/40 strategy, you need to understand these cycles and how they affect your portfolio. A market cycle is simply the natural rise and fall of the markets over time. Boom periods followed by busts. Growth followed by contraction. If you can navigate these cycles with skill and precision, the 60/40 strategy can work wonders for you. During a market boom, it's easy to get greedy. The riskier part of your portfolio, the 40%, will likely show great returns. The growth stocks you pick, the startups you've invested in, or the emerging technologies you've backed will likely see significant gains. And in these times, there's a temptation to go all in on riskier assets, to increase that 40% and take more bets on high growth opportunities. But if you get too aggressive, you can end up setting yourself up for a fall. The key during these times is to stay disciplined. Do not let the good times cloud your judgment. Remember, the strategy is about balance. Conversely, during market downturns, the fear factor is high. The 40% of your portfolio might take a hit. But this is exactly why you need the 60%. The stable portion of your portfolio, whether it's bonds, real estate, or dividend-paying stocks, will help to cushion the blow. It's the foundation that keeps your portfolio intact when the market crashes. During downturns, many investors panic, sell off their riskier assets at a loss, and lock in their mistakes, but not you. You've already prepared yourself with a solid foundation of stable assets. Now, it's about staying calm, keeping your emotions in check, and letting your 60% cushion the losses while the market inevitably rebounds. What's crucial here is that market cycles are not predictable. If you try to time the market thinking you can know exactly when a boom or bust is coming, you'll end up losing more than you gain. Instead, Your approach should be to remain consistent, to continue to implement the 60/40 strategy without trying to chase short-term gains. Over time, the market will reward patience. It's not about trying to outsmart the market. It's about positioning yourself so that no matter what the market throws your way, you have a strategy in place that can help you weather the storm and thrive during the good times. Understanding market cycles and being emotionally prepared to ride them out is the true strength of the 60/40 strategy. Leveraging tax strategies to optimize the 60/40 portfolio. Let's talk about taxes. It's a topic that many investors avoid, but let me tell you, tax efficiency can make or break your portfolio. When applying the 60/40 strategy, you need to be mindful of the tax implications on both sides of your allocation. The goal is to not only achieve growth, but to ensure that you keep as much of that growth as possible in your pocket. If you're not paying attention to taxes, you're leaving money on the table. So how do you maximize the 60/40 strategy with tax efficiency? First off, the type of assets you hold in each part of your portfolio matters. For your 60%, the stable portion of your assets, consider utilizing tax-advantaged accounts like IRAs or 401ks. These accounts allow your investments to grow tax-deferred, which means you don't have to pay taxes on your earnings until you withdraw them. This is a powerful tool because it allows your stable investments, whether they be bonds, dividend stocks, or real estate, to grow faster without being hindered by annual taxes on interest or dividends. The key here is to make sure you're taking full advantage of these tax-deferred accounts for your safer investments. On the other hand, when it comes to your 40%, the higher risk portion of your portfolio, you need to be strategic about where you place certain assets. Growth stocks, startups, or speculative investments often come with high capital gains taxes, especially if you're selling within a short time frame. But there's a solution: long-term investing. By holding these assets for over a year, you can take advantage of lower long-term capital gains tax rates. This tax break can make a massive difference when you're realizing returns on your riskier investments. The key here is to avoid getting greedy and selling too quickly. Long-term investing isn't just about patience, it's about tax optimization. Beyond that, you need to think about tax loss harvesting. If your 40% portion takes a hit and some of your assets are down in value, you might want to consider selling those assets to lock in a loss. This is a tax strategy that allows you to offset gains in other areas of your portfolio. By selling losing assets, you can use those losses to offset any taxable gains from the rest of your portfolio. This strategy helps reduce your tax liability and keeps more of your money working for you. But just like any other strategy, tax loss harvesting requires timing and a disciplined approach. Don't make the mistake of selling off everything just to avoid paying taxes. It's about smartly managing your assets and understanding the tax implications of your decisions. Let's not forget the importance of dividends and interest. The income generated from your 60% portfolio can be subject to tax, and in many cases, dividends are taxed at a higher rate than long-term capital gains. If you're not careful, this could eat into your returns. One way to reduce the impact of this is to place high-yield dividend stocks in tax-deferred accounts, like your IRA or 401k. This strategy allows you to receive dividends without the tax bite, further boosting the overall return of your portfolio. By taking these considerations into account, you can fine-tune the 60/40 strategy and ensure that you're not just achieving growth, but maximizing the returns that actually end up in your pocket. Ladies and gentlemen, applying the 60/40 strategy is not about following a simple rule. It's about mastering a framework that allows you to balance risk and reward, stability and growth, all while staying ahead of the competition. It's a mindset that requires commitment, discipline, and an understanding of both the markets and your own psychological tendencies. You must have the resilience to stick to your strategy when everyone else is losing their minds. You need to be able to think long-term, even when the short-term volatility wants to throw you off course. And above all, you must understand the nuances of taxation, market cycles, and asset allocation if you want to maximize the potential of this strategy. Remember, the 60/40 strategy isn't just for seasoned investors. It's for anyone who's serious about growing wealth and taking control of their financial future. So, get comfortable with risk, take full advantage of the tax strategies available to you, and stay disciplined. Apply the 60/40 strategy with precision, and you'll find that the results speak for themselves. It's time to stop making excuses and start executing. The road to wealth is paved with hard work, strategy, and the willingness to take the right risks at the right time. This is your time. Let's go.